All right, well, welcome everybody. I'm James Orr. We're going to get started at 6 o'clock. I tend to be on time, and if people come in late, that's totally cool. I have no problem with it. We do these classes locally and have been doing these classes since 2003 locally. And sometimes in the class, there's two people, and I start on time with two people. Sometimes in the class, there's standing room only, and there's 6 people standing for 2.5 hours, and I start on time for them as well. So we're just going to get started. People can kind of come in late if they want to. But I have a special guest on tonight. I'm James Orr, real estate broker in Northern Colorado, Fort Collins market. And I have with me tonight my good friend, longtime good friend, Jassen Bowman. Jason, are you there?
I am. Thanks for having me on.
You're very welcome, man. Thank you for coming on too. Last week we did our first webinar as we kind of roll out some of the Nomad stuff nationwide. We kind of started with 20 additional cities, and we're just starting to get those rolling and looking for volunteers in other markets and stuff. But one of the things I noticed about last week's webinar that we did was it was basically like me talking without any type of feedback for most of the presentation. We had people kind of chatting in the Zoom webinar chat window, which you guys are welcome to do and ask questions and kind of communicate that way. I kind of like that. I kind of like it being broken up and questions being asked. But one of the things I have a hard time with is when I do like live classes, we do a lot of back and forth conversation of, does that make sense? What are your questions about that? And I prefer to teach that way instead of just doing lecturing and hear myself speak for 2 hours straight. And
Same here.
Much faster when I do that. So having you on is going to definitely be helpful with allowing me to, kind of pause and take a drink, and you can ask questions. And you're a really smart guy. And, I kind of want to talk about your history here in a second as we kind of ask people to do introductions. So that people can get to know you as well. But, you're a super sharp guy, and you're a fellow Nomad. You're doing the Nomad model and actively doing it. And
I am.
Probably, a couple steps ahead of a few people on here. So, let's kind of jump into this, and then I'll have you do an introduction in a minute, if that's all right with you.
Absolutely.
Okay, cool. So this is going to be Financing Nomad 101. We've done presentations on financing in the past, where we just do general real estate investor financing stuff. This one is really about financing the Nomad model, because we're doing this. Tuesday night webinars are really all about Nomad. And people that are premium Nomads can go on to learntoberich.com/financing Nomad 101. It's right there on the screen. And they can access the previous recordings. And if I do any additional checklists or resources and stuff, I'll put those up there as well. So let's do some introductions from people. So in the chat window, if you would, who you are and what city and state you're from would be really helpful for us. And then, Jason and I will do introductions. And then what class would you like to see taught about Nomad? We've got a whole schedule planned out for the year, but there may be some classes that, I haven't scheduled that you guys really want to see. And I'm not opposed to doing a breakout session, another class where we do something, or replace one that's not a popular topic with the one that's a little bit more needed. So if you could, in the chat window, just let me know who you are, where you're from, city and state, and then what class. And Jason, if you wouldn't mind, kind of sharing some of your background, especially stuff that's relative to kind of the Nomad and kind of in many ways coming back from some financial stuff, if you're willing to share that.
Yeah. So I don't know, how far back do you want me to go?
It's up to you. I think learning a little bit about you will help people understand when we talk about financing tonight. So
cool. So I started real estate investing back when I was married, living in Fort Collins. Got a divorce, unfortunately, and in the divorce, I got the rental property. Shortly thereafter, I wandered into the public library downtown, and there was this thing going on, and this guy named James was talking about like this crazy stuff I'd never heard before, like subject to and lease options and all that kind of stuff. Oh, that's how you and I met, and we've done some projects together over the years, off and on, and you've been a great friend, and which I appreciate. So I guess kind of on the financial side, you and I were brokers together at Keller Williams in, was that 2007, I believe it was.
Yeah, what year did we meet? What year did you come to the library?
Oh, that was 05, late 05.
So we started the group in 03, so that must have been a couple of years in.
Yeah. Well, and it was interesting is because even before that, I remember back when I was a sales rep at the Fort Collins Forum newspaper, I actually met and pitched your to sell advertising to Paul, I believe it was. You're a real estate investing partner from your previous company. So there was a connection there, even going back to 03, when you were running Mammoth. So in 07 we were at Keller Williams. Long story short, real estate crash. I ended up in Chapter 7 bankruptcy. Lost everything. Spent 10 months living in a van down by the river, down by Boulder Creek, actually. Just needed to put food on the dashboard. So I ended up taking just an entry-level kind of menial job at a tax outfit down there. And about a year and a half later, I was dang near running the place, and I had my IRS license, and I was building out a practice, then went into private practice for a while. Obviously, the bankruptcy destroyed my credit, totally obliterated any chance I had of ever being able to borrow a dime from anybody. And so while I was working on running kind of a virtual tax office, my area of specialization is helping people that owe back taxes to the IRS. I'm one of those people. And but I was doing it largely while being literally a nomad. And I traveled around the world 2.5 times in the course of 3 years. And again, long story short, I ended up coming back to the States. When was that? Summer of 2014 is when I landed back here. And I've been working on building another company, a Seattle tech startup, pretty much ever since. And because I knew I was going to be here in the area for kind of a long haul by my standards, probably a 5 to 7 year commitment to build a tech company, I decided that I wanted to get back into real estate investing, especially because, I was at that magical 7-year mark on a lot of my old credit issues, where things start to improve and mortgage companies will start looking at you again. And you encouraged me to start doing this this buy and hold model that completely 100% had nothing to do with any of the, I guess I would use the word sexier sounding creative real estate models that that you've taught before, we've talked about before, but that kind of entails some significant risk. And so I started looking at this model, and I closed on my first property. I bought a duplex in August of 2015 on a no money down VA loan.
Mm-hmm. We'll talk about that tonight.
And then a lot of folks don't realize that you can actually have multiple VA loans.
That's true too.
At the same time.
We'll talk about that tonight too.
So wait, what is today? Am I at a month? Yeah, exactly 30 days ago, I closed on house number 2, a single family home in the same city here in Bremerton, on a VA loan as well. And I'm doing some light renovations. It's not a flip kind of situation, but I'm doing some light renovations on the duplex unit I was living in right now, and that place will be rented out February 1st.
That's awesome. I appreciate you kind of giving some background, and especially your willingness to kind of share, some of the financial challenges before, because, a lot of people don't know I had some financial challenges as well, and I'm willing to share some of those things with you as well. But the thing that's impressive is that you're able to kind of come back, and now you're on the path to acquire a bunch of rental properties and do the kind of catch-up nomad model in a lot of ways to acquire a massive rental properties and do it. And you're starting off doing it with nothing down, which is a pretty interesting thing. So, just a really brief kind of version of my background story, kind of relating to some of the stuff too, is at the peak I had 26 single family home properties, and I got hit in the downturn. I had a pretty significant income loss, 6-figure income loss in one day, and ended up opting, after feeding the properties for quite a while during the downturn, a big real estate downturn. Had a bunch of foreclosures and bankruptcy, And, we're doing Catch Up Nomad Comeback as well. And so, now I'm at, I have ownership interest in just over and more than 10 units. I'm not going to tell you exactly the number, but it's definitely more than 10. And we're doing Catch Up Nomad as well. My wife and I are, once our kind of credit improves as well. And so, the Nomad model is a great way to kind of recover from some of these financial setbacks. We don't usually talk about that a lot in the classes, but it really is a good model for that. And so, yeah, I think we'll learn a lot tonight when we talk about the financing stuff. So one thing I did want to mention, looks like we had a bunch of people kind of introduce themselves. Thanks everyone for doing that and welcome. We only had one person kind of suggest a class. Sandy suggested, I'd like to see a class on managing risk once you're renting property. And I do a class on that. It's called Warning: The Dangers and Risks of Real Estate Investing. And we go through every risk that you could possibly imagine about investment property, renting property. And we talk about, what the risks are and then what we can do to mitigate the risks and what happens in worst case scenarios. And we kind of walk through that and try to come up with ideas to mitigate and minimize those risks that we can. And so there's definitely a class on that. I think it's scheduled toward the end of the year. Premium Nomads, I think there's a recording of it up on the website already, but we are teaching that again live toward the end of the year. So we do plan on that one. If anyone has any other classes, they're welcome to share those. So, all right, so speaking of classes that are coming up, here's the upcoming class schedule. So next Tuesday is the buying process overview for Nomads. We're going to walk you through the checklist for buying a property, basically what happens when you're out there looking for properties to do that. And then the next class on Tuesday, January 31st, is going to be finding properties for Nomads. It's going to be all about setting up property searches and what you look for in properties and things of that nature. Then Nomad 101, it's sort of like a potpourri class of all the frequently asked questions you have about Nomad. You can bring questions about financing to exit strategies to whatever it is that you want to learn about. And there's going to be a frequently asked questions that I'll come up with. But I strongly encourage people, if you can use the chat window anytime during this presentation and ask questions. I don't mind taking questions live and going off topic. In fact, some of the more interesting things kind of come up when people make odd connections that I wouldn't have otherwise made. So then on February 14th, Analyzing Deals 101, Intro to Cash on Cash Return on Investment. One of the things we're concerned about when we're doing the Nomad model, and I'm going to cover what the Nomad model is here in a moment for those of you that don't know, but one of the things we really focus on is that cash on cash return. And in some markets, it's really hard to get positive cash on cash return. In our market, it's hard to do. Especially as interest rates go up and the property values continue to increase. So we're going to talk about how to analyze deals and how to, when you're buying property, definitely take that into account. And if you want to see the full class schedule, you're welcome to go to the learntoberichcom.com/schedule and see that. So Jason, since you're kind of, our typical, sample Nomad for tonight, what is Nomad for you?
Nomad for me is, well, beyond what you have here on the screen, Nomad for me is a way to accelerate my retirement plan.
Okay.
It's like you said earlier, it's straight catch up. But basically what it is you buy a house for using owner-occupant financing,
yep,
which gets you better terms than investor financing.
Yep.
And I've bought my first 3 units now, two houses. First one's a duplex. So 3 units now with no money down.
Yeah.
And I'm out of pocket a total of about $8,500 or so in closing costs.
So let's talk about that for a second. So you say no money down and people automatically assume that you didn't have to have any money. So is it possible for you, could you have, if you chose to, and it's up to you, but could you have, if you chose to, actually finance those VA closing costs, the VA funding fee and some of the other incidental closing costs?
Well, the VA funding fee on both was financed in, and
okay,
for both, and for those of you that are using your second tier entitlement, your second VA loan, the funding fee is a lot higher.
Okay.
That's one of the downsides. So I did finance both of those in, and depending on where you are in the country, it is very, very common to ask the seller to pay for a significant chunk of your closing costs.
Yeah. So here in our market, Northern Colorado, we're in probably the hottest real estate market we've ever seen. And it's hard to get a seller to agree to seller concessions, which is what we call them here.
Mm-hmm.
But yeah, right. In a lot of markets where it's normal, especially on properties that have been on the market for a little while, it is much more common to either ask the seller to contribute those or raise the price and ask the seller to contribute those, where the seller nets the same amount they would if you made a full price offer and asked for those seller concessions. So
Yeah.
you could have, is what you're saying, you could have actually financed in those $8,000 and change in closing costs. Is that right?
Yeah, the appraisal on both houses I bought
Mhm.
came in significantly higher than my purchase price.
Okay.
So I could have done exactly what you just said.
Okay, cool. So when we say no money down, there are people that, they could do it with really no money down, but you just said you didn't put any down payment, but you did pay the closing costs out of pocket.
Correct.
Okay. So let's get back to what is Nomad. I just wanted to go off topic to kind of clarify that for people. So buy a home as owner occupant. You're going to live there for a year. Why do you live there for a year? Why are you moving into these properties?
Well, like I said, you get better terms. Interest rates on investor loans are about 1% higher or so. Also, you can't get in with no money down on an investor loan.
So why not just say I'm getting a loan and not move in? Why not just say, hey, listen, I'm going to live there and move into the property?
Well, technically, if you wanted to do that, you theoretically could. But you would very, very quickly have some brand new friends at the FBI and a local correctional facility.
Okay. So what you're saying is it's loan fraud to do that.
Correct.
Okay. So we do not recommend that. I was kind of being a little bit silly. But yeah, we really focus on doing whatever we can and obey the rules of the lender. We consider a lender a good loan partner, a partner in this whole deal, where they're going to bring the majority of the money for you to buy these properties and just follow their rules. And one of the things that they require you do is at closing, they're going to have you sign something that says you're going to remain in the property as an owner occupant for a year. And if your lender doesn't require that, then you can do a variation of Nomad where you don't have to stay there for a year. But almost every lender I know of, I cannot think of an example, they're going to require that you move into the property and stay there for a year. So we buy the property as an owner occupant. We live there for a year. Then we buy a new house after we've lived there for a year, and we convert the previous one to a rental. And then you repeat that process until you get as many rental properties as you want. Whether that's one rental property or, as we normally model, we model about 10. And the 10 comes from a loan limit. So basically, we talk about, how to use this strategy in order to acquire 10 rental properties over 10 years. That's the fastest you can do it with the model that we have. So does that make sense, Jason?
Absolutely. And
Okay.
and I want to throw out there on that mortgage fraud thing, for anybody that thinks, oh, how are they ever going to know? In my first year when I bought the duplex, I had 2 occupancy checks conducted on me.
Really?
Yes. And I've been in, and remember, I'm using my VA loan for a second time. I've been in here for exactly a month. I've already had 1 occupancy check as well.
Wow.
Okay. And keep in mind, I live in a military town. This is a Navy community, so it may perhaps be more prevalent, this VA loan fraud, in a military community than it might be in like Fort Collins. But they do check. So just want to.
That's actually really interesting. I had not known that they were doing it that frequently, but I believe that they do check. I just didn't realize they were doing it that much. So
yep.
Yeah, don't do it, guys. I mean, the model works great. Don't try to improve my model and say I'm going to do James's Nomad model, except I'm actually just going to say I'm moving into the property, and then I'm actually not going to move in because I don't really need to move in. I don't want to move in. You got to move in. It's the benefit of doing the model, is being able to get in with these little or nothing down loan programs and acquire rental properties, but really, really hard to do if you're not moving in. So, all right, so let's talk about some financing stuff. Jason and I have talked about this before. Real estate is said to be the ideal investment, and it's an acronym for all the different benefits of real estate. And if you kind of remember these, you can remember all the different returns you're getting from real estate. So income or cash flow, depreciation, which is also your tax benefits. And as an aside, just because I have you on the line, so Jason is my kind of go-to tax guy. If I have a tax question, he is probably the smartest guy I know, especially in regards to taxes, where if I have questions about stuff, he's the guy I call to make sure things are right and stuff like that. So basically, he's my tax guy. So depreciation is the tax benefits of owning real estate. E stands for equity buildup. It's paying down on the loan as you own the property. A is for appreciation, and then L is for leverage. And without leverage, my friend Brian likes to say, it's just a great idea. It's not really ideal. And so that's kind of his little twist on the model there. And so tonight, since we're talking a lot about financing, it's really about the leverage part of it. And we're going to talk about what Nomad looks like as far as leverage. Eddie, you had said FHA approved. I'm not sure what you were referring to there. So if you want to clarify, I'd be happy to kind of talk about that. And any other questions, go ahead and do the Zoom chat there, the webinar chat, and I'd be happy to answer questions for you. So kind of covering this, I have this little visual graphic up on the screen. It's like a blue, green, red, and yellow thing with a little white box in the middle. And those stand for the 4 different areas of return that we see on investment properties. The blue one is for appreciation. That's a tendency for property values to go up over time. The green is cash flow. That's the monthly cash you generate from the property after all your expenses, including your mortgage, your taxes, your insurance, property maintenance, management on the property. So that's your number after all those expenses. The red one is your debt pay down. That's how much you're paying down the loan. And the yellow one are the tax benefits. And that's a pre-tax tax benefit. And I'll talk to you what that means here in a minute. And then in the middle, ROI stands for the sum of all of the 4 areas of return that you're getting on that. And so this kind of graphic here, I see your question there, Eddie. I'll get to it in a second. So basically, these 4 different areas of return summed up equals 7.2, and this is without getting a loan. So these are the assumptions without leverage. So I know in some of the markets, I'm gonna name on here that I say the word 200. I say $200,000 property, and you're like $200,000 for what? The land? I mean, I realize you guys are in some other markets, and this is really low for our market too. It's definitely way below median. But if you bought a $200,000 house and you put the full $200,000 down, 100% down, and you had the full net operating income as cash flow, and those of you who've taken my kind of analysis class understand what I'm talking about. I'll cover that in another class in detail. But basically, that's your cash flow after all expenses, not including debt. But in this case, there is no debt, so it is your full cash flow. So if you have your full net operating income as cash flow on the property, we assumed a 3% appreciation rate, which means you're getting a 3% return because you paid all cash for it. And you have no return from debt pay down because you don't have a loan. So really, your appreciation return is 3%. Your cash flow return is 1.2%. It's whatever the number worked out to be divided by 12. And then debt pay down, nothing. Your tax benefits, you get to take away the value of the land. You take the value of the building itself without the land. You divide by 27.5 years for residential property, and that's the tax benefit you get. The really rough rule of thumb for that is it works out to be usually about 3% of the property value. So if you're buying a $300,000 property, take 3% times that, and you're getting a tax benefit of about $15K a year. So you add those 3 up, 3% plus 3% plus 1.2, and you get an overall return on investment of 7.2% if you bought the property for all cash. Does that make sense, Jason?
Absolutely.
Okay, good. So now let's take a look at what happens if instead of putting down $200,000 on a $200,000 property, let's say we only put 20% down. Well, what ends up happening is you typically increase your return by a factor of about 5. So the same 3% appreciation. So on a $200,000 property, the property goes up 3%. You end up getting a $6,000 return. Well, $6,000 on investing $20,000. I'm sorry, investing $40,000, $20,000 down works out to be a return of about 15% per year. So because you're using financing and leverage, you've increased your return by a factor of 5. So it went from 3% to 15%. Your cash flow on this particular property went from the full net operating income to now you got to pay a loan out of that, and the cash flow on it worked out to be about a 6% return on the amount you invested on the $40,000. The debt pay down, the amount of return you're getting from paying down the loan is about 5.5%, and then the tax benefits on it is about 14.55. So the overall return on this is about 41% on a property when you use 20% down financing. Okay. Now you can totally do 20% down financing, but with the Nomad model, typically we're doing either nothing down or very little down type of financing. And most of the time we model Nomad, we're using 5%. Okay. So let's take a look at what using a 5% down payment changes the return to. So if you use Nomad leverage, basically you put 5% down or $10,000 on a $200,000 property, your appreciation, that same $6,000 that you went up in value on the property, 3% appreciation, means that you're getting a 60% return on the $10,000 you invested because you made $6K on a $10,000 investment. The cash flow, we're assuming if you're only putting 5% down, if you're only putting 10K down, you don't have any cash flow. We're assuming that your cash flow goes away. And in fact, in a lot of cases, it's going to be negative. And we're going to talk about that when we talk about improving cash flow and how to eliminate that negative cash flow. Okay. The debt pay down, well, you're getting almost a 10% return on the money that you're making, on the money that you invested. So, 10% on the $10,000 is what you're paying down each year on the loan. And then the tax benefits of it, you're getting that same, 3% or so of the value of the property in tax benefits, but you only put $10,000 down. So in this case, you're really making about a 58% return from your tax benefits. Your overall return on that property is about 128%. So your return on investment goes up significantly as you put less down because you're higher leveraged. Does that make sense?
Sure does.
Okay, cool. So we're going to go talk about what's that? I'm sorry?
Numbers are good.
Yeah, the numbers are pretty compelling for doing Nomad, and that's one of the big appeals of putting less down. You can acquire these, $200,000 assets with, in your case, nothing down as far as down payment, but some closing costs. But in most cases, we're putting 5% down on these properties. Mm-hmm. So this is kind of my flow chart where we talk about, the different steps when you're kind of working with a real estate agent to buy a property. The blue ones are areas that we're going to kind of touch on tonight. The green one is the one we're going to cover first. So we're going to start with the first time you sit down with your real estate agent to kind of go over some things. And we're going to particularly talk about the financing parts of this discussion. So when you sit down with your real estate agent for the first time, these are all the different things we discuss. And we're going to cover this, I think, in the buying process overview. But the ones I'm going to talk about first is the financing. So when we sit down and we're having a burrito at Qdoba and we're talking about you, getting involved in real estate, we're going to sit down, we're going to talk about what's your plan for financing. Are you going to put 20% down? Are you going to do Nomad and do 5% down or 1% down? Do you have VA loans? Can you do 0% down? And we're going to talk about those different strategies. And that's what we're going to start with tonight. And then later on, we're going to talk about how the loan piece touches on writing offers. All right, let me just pause for a second. So Eddie says FHA approved. For an FHA approved loan in income property, it must be owner occupied. Yep, exactly. So we're talking about FHA. You can buy, we're going to talk about that a lot in detail tonight, but yeah, we're talking about being able to owner occupy properties with FHA, and the same thing with VA, it has to be owner occupied. All right, types of financing. So these loan programs can change at any time. There's probably some real estate agents on the webinar tonight, or they're probably going to listen to this recording. And I will just tell you that my personal philosophy, I'm a real estate broker here in Fort Collins. I work with probably 90% either nomads or real estate investors in our business. I think last year we did, 44 sides, 44 transactions. I think I'm the number 4 real estate broker in our marketplace from a buyer's agent side. But to kind of give you an idea, I don't memorize all these financing rules. Okay, so if you're kind of wondering, do I need to become an expert on these? I think you need to understand them. But really, I don't want to go and tell a client that you can go get this loan and you definitely can do it. I know you can do it. I'd much rather say, my understanding is the loan program works like this. Let's go ahead and get lender A or B or C or all 3 of them on the line and have them tell you about the loan programs, because they deal with them every day. And the loan programs change. And it may not change like every week, but they change frequently enough that you don't want to get in a situation where you're like, oh, I did one of those loans 6 months ago. Here's how it worked, only to find out that either they had a new overlay or they had an actual change in the underlying policy and they no longer do loans like that. So rather than overpromise, I'd rather just tell people, let's go talk to the lender and get it straight from them. So I don't think you need to become a super detailed expert and know every program, but I think you should definitely know how these loan programs work and in general what their kind of qualification policies are. Does that make sense? Can
I add something to that real quick?
Yeah.
I think this became an issue when I first started looking at this process in the spring of 2015. When I started looking for a house, looking for a lender, I talked to lenders from, I figured, I just go to my credit union, or I'd go to the large national commercial bank where I have my business banking account, and I'd work with them. And what I discovered was that the local person at the credit union, the local person at that particular bank, they weren't familiar actually with the VA loan programs. Because the credit union, I won't name the name because they're also there in Fort Collins, but they deal with large tech companies. And so they're used to not dealing with veterans.
Yep.
They're used to dealing with jumbo loans because they're these high paid engineers that buy, jumbo loan houses.
Yeah.
The local bank, even though it's a military town, they were new to the job. They didn't understand the loan product. And so I had to go outside my normal banking universe, I guess, in order to find somebody that understood the program I wanted to use. So I just want to encourage people to make sure that they're working with somebody that understands what you're trying to do, and that also understands the Nomad concept. I think that that's important as well.
Yeah, we're going to talk about that a little bit, but one of my favorite lenders doesn't understand Nomad. They've not come, they're not taking the time to come to class. They don't understand what we're trying to do.
That's too bad.
Their loan programs are so good that sometimes when I'm sitting down with a client and I've got, a client, I'm saying, okay, so we're going to have you go talk to a couple different lenders. Let me kind of give you a rundown of some of my favorite lenders and why. And, one of them I'll say, this person's come to class. You've met them before. They're pretty sharp. They're kind of a Midwest personality. They're a straight shooter. They're going to tell you how it is. They're not going to like poo-poo you and kind of make you feel good. They're just going to tell you straight up, yes or no, kind of factual stuff. But their rates are probably the second cheapest, just from experience. And definitely come back to me and tell me if I'm wrong on this. But the rates are probably the second cheapest. Their kind of fees are a little bit lower. So I definitely call them and get quotes, and we'll talk about that later today. But this other lender, they're usually my kind of least expensive lender, and they've got a couple of little perks, like they include the cost of the appraisal in there, but they don't understand what we're trying to do. If you go down there and say, hey, listen, I'm talking to James, I'm thinking about doing Nomad, they're going to be like, what are you doing? I don't understand what you're saying. So just realize if you're talking to them, they may have the better rate, but you're not going to be able to have discussions and planning talks about that. And in some cases, I think personality definitely matters, but in some cases, the ability to talk and plan with your lender for a 10 loan program, I'm doing 10 loans over 10 years, is going to make enough of a difference that it might be worth paying a little bit extra in just costs of doing loan to have someone who is knowledgeable and understands what you're trying to do and can talk and guide you and help you with that. And so it's really up to you, but that's what I end up doing with a lot of clients.
I can tell you that I'm paying slightly higher origination fees on the two transactions I've done because I found somebody that understood what I'm trying to do and has access to the loan programs that I'm going to need, not just now with the VA side, but also for house number 3, 4, 5, etc. So I am paying a slight premium for her expertise, but I think it's worth it.
Yeah, and every buyer needs to make that decision for themselves, right? Some buyers are every penny matters. I want the cheapest one, even if it's going to be more work for me and it's going to be frustrating for me and it's not going to be as pleasant and I'm not going to be able to have good conversations. I'm willing to do that because I want to save $500 or $1,000 or whatever the number is, right? Whatever it works out for you. And then there are other people that are like, for peace of mind and for good planning and having a good team in place, I'm willing to pay a small premium to have a really good person that I'm working with and can plan with.
Yeah. And just for the record, that whole dream team thing is something I learned from you years ago.
Yeah.
So I mean, you taught me the value of being willing to pay a little bit extra for the right expertise. And it's hard to swallow sometimes, but I think it's worthwhile.
Yeah, and sometimes it's hard to know, right? Because you can only go down one path and use one in the transaction, and you're not sure if you had gone with someone else, if it would have gone as smooth or you would have had problems. But I will give you just one very brief example here. I had a recent deal that just closed, and the lender made all the difference. Kind of one of the wackiest deals I've ever done. They required 2 separate sequential appraisals that we didn't find out until just really, really wacky stuff. And the lender, because I think partially because they had an affinity for this client, they knew the client was a good long-term client, was going to do multiple deals with them over a period of time. And, I'm a good source of business for them, that they wanted to take care of me and they wanted to make sure that the business was going to be good, is when the second request for the appraisal came in, they were not allowed to charge the appraisal back to the buyer. And this was over Christmas. And so the second appraisal needed to be rushed. It cost like almost $2,000 to have the second appraisal done. Wow. And the lender ate it. The lender paid for it, knowing that if the loan still didn't close, they would have just paid out $2,000 for this client.
Wow.
So stuff like that matters. And so I think that, it's not always about who's the absolute cheapest. Sometimes it's about relationships and knowing that a lender is going to go out of their way to make things happen. There's other things that lender did in that transaction that made a difference too, but that was probably the big one.
Things that made the difference between closing and not closing?
Oh, absolutely. It would not have closed unless this lender had stepped up.
Perfect.
And once they got invested in the deal, once they had put out that money for the second appraisal anyway, they almost like were committed and they had to like go do things that they might not otherwise have done for, just a client that was like shopping them around to 3 guys and,
right.
They were going to be gone the next deal if they weren't the cheapest. So I think that buys you quite a bit, but yeah, let's get back to the presentation. We got quite a bit to cover. So, all right. So types of financing, nothing down. This is one of the loan programs that you decide to use that, the Veterans Affairs loan, the VA loan, it is Nomad approved. It's one of the loans that we suggest for nomads. In order to qualify for it, you need to have VA benefits. Do you know what the VA benefits, what the qualification is? Both you and I were in the military, but you tend to know a lot more stuff about it.
I believe that, and again, please quote me on this. I believe that if you served at least 90 days on active duty, or at least 6 months in the reserves, I think it is,
okay.
That you can qualify. So basically, anybody that did at least one tour, you should be good to go.
Okay, is it like if you have a DD-214, you can do it? Or is it something else specific? Do you know?
Well, as long as you have anything. I mean, if you have a dishonorable discharge, I don't think you're eligible.
Okay.
I think you have to have an honorable or other than honorable discharge. But yeah, if you have that, I believe that's all that's required.
Okay, that's kind of cool. All right, so you have to have VA benefits, and not everyone has it. It's a fixed rate with no private mortgage insurance on the loan. So for those of you that don't know what private mortgage insurance is insurance that you usually pay for as the buyer to protect the lender in case you default. So here's the idea. If you put less than 20% down the property, the lender says, hey, listen, I'll make you a loan, but what I want you to do is I want you to make a payment to a third party, and if for some reason you default on the loan, I want that third party to come in and make me whole for the amount I lost up to a certain limit, okay? So that's the basic idea, is that you as the buyer, the borrower, are coming in, you're paying a third party a fee, private mortgage insurance, that's what the fee is, and they're saying the third party is going to insure you in case you default on the loan. So it's really protection for the lender to do it. So Andrew says 100% benefits is 36 months active duty. I appreciate that update. Thank you. So basically, that's what PMI is. And PMI does not exist on VA loans. It's a fixed rate loan, so there's no variable rate loans on that, and there's no PMI, even if you're borrowing 100%. Okay, you must own or occupy the property, which is fine. As nomads, we're moving into the properties. You can do 1 to 4 units. So there's only 2 loans that I know of where we can buy multifamilies, and those are VA and FHA loans. And so you were able to go buy, Jason, your duplex with a VA loan because it does 1 to 4 units. Mm-hmm. Okay. You can do multiple loans possible, and you're going to want to ask your lender for details, but it has to do with how much of your VA benefit you're using, is my understanding. Is that right?
Yes.
Yep. So talk to your lender about that. But if you have a VA loan, you bought a duplex, it's possible you could use your VA loan on your next purchase as well. Okay. It's offered longer and stricter appraisal. So it's a little bit more involved appraisal process. And some sellers don't like that, right? Some sellers say, hey, listen, I don't want to deal with a VA loan. It takes a little longer. They're going to be a little bit more strict about the condition of the property for health and safety reasons and things of that nature. And so you will get some sellers that push back a little bit on those.
On both properties that I bought, there were the duplex required about $2,000 or $3,000 worth of work that I was not allowed to pay for. The seller had to pay for that. On the second house, there was probably about $1,500 worth of work that the seller had to shell out for. And so, yeah, a lot of times they don't like that.
Yeah. And then for seller concessions, where the seller contributes towards your closing costs, you can have 4% of the purchase price go towards seller concessions with a VA loan. That's their limit. Okay. Any questions on VA loans anyone has? And I like VA loans for doing Nomad stuff. So if you have VA benefits, I think it's a good choice, especially early on if you're doing multifamily. All right, next one is the U.S. Department of Agriculture, or commonly referred to as the USDA loan. That is also Nomad approved. is primarily for rural properties, properties that are outside of city limits. And the way to find out if your property will qualify is, number one, talk to your agent or your lender. But there's a website you can go to. Just go search, USDA, property area or search area or qualification or something like that, and you'll get the USDA website where you can type in the address of a property, and it will tell you whether or not that property is within the USDA approved area to buy property. And so those are typically rural properties. Like if you were in our local market, you can't buy a property USDA in Fort Collins. It just doesn't qualify. But Windsor qualifies, oddly enough. Most of Windsor qualifies for USDA, and I think parts of Greeley does as well. Other than that, you have to go outside of city limits in order to qualify for those types of properties. Okay? So unlike VA, where you personally need to qualify for the VA loan, you need to have those benefits, USDA, the property needs to qualify for those benefits. It's kind of a little different qualification there. So they're also 100% financing, so nothing down loan programs. It's a fixed rate loan, but it does have PMI. So it has private mortgage insurance, which is an extra, usually monthly payment that you're paying in order to have that privilege of borrowing less or borrowing more, putting less down on the property. Okay. USDA, we have to owner occupy the property. There are income restrictions. So if you make too much money, you will not qualify. You can use the USDA mapping tool to verify property qualifies. We talked about that. And many agents don't correctly identify properties that qualify when listing in the MLS. So if you came up to me and you said, hey, listen, James, I want you to send me a list of all the properties in your local MLS that say that they're good for USDA, I could totally go into my MLS and select properties that say they qualify for USDA loans, and I could send those to you. Unfortunately, there's a certain percentage of real estate agents that don't understand what USDA qualification is, and they just check off the box when they list it in the MLS, such that you'll get properties that really don't qualify. And equally as annoying, if you have properties that do qualify, they may not have checked the box off saying that it was USDA qualified. So it's not a good thing for you to just say, send me the ones that qualify for USDA. That's not a good way to search. So what you really want to do is say, okay, I went and I looked on the map, and I know that this whole area of town is qualified for USDA. Can you please send me the properties that come up for sale in that area? And then I'll manually go and verify with my kind of USDA website to verify that they are USDA qualified. Does that make sense?
Yep.
Okay, cool. And then for USDA, it's a 6% maximum seller concession. So the seller can contribute up to 6% of the purchase price of the property towards your closing costs if you want to. So to recap, if you want to do nothing down, those are the two loan choices, VA or USDA. Those are the ones you can buy with no money down in our local marketplace, and actually in most marketplaces. Okay?
Good programs.
Yep, I agree.
Big fan.
Yeah, so the next one is FHA. That's the Federal Housing Administration loan. It's also Nomad approved, and it's mostly 3.5% down. However, there are some unusual exceptions. Occasionally, lenders will come up with FHA programs that you can use in combination with some down payment assistance programs, which can lower the amount you need for down payment. So it could be a 3.5% down FHA loan, but with a down payment assistance program, you only need $1,000 to close on, or you only need 1% to close on it. And those are lender specific. So you got to search them out and find them, and ask your local real estate agent kind of, who their lenders are that they know of that have these down payment assistance programs. Some of them are city-based, some of them are county-based, some of them are just special programs that they happen to have through particular lenders. So you really need to shop around and find out. But FHA by itself is 3.5%. Okay? It's a fixed rate loan with PMI. And the PMI on FHA is particularly gnarly, in my opinion, because it can't be canceled. There used to be a time when your property value either went up or the amount you owed on the loan went down, and you had a certain amount of equity in the property that the PMI payment would go away. And a couple of years ago, I think they changed that so that the PMI never goes away on FHA anymore. And the way you get rid of it is you have to refinance out of the property. Okay? So just be careful with the PMI on that one. The one nice thing about FHA loans is that they are very credit challenge, past blemish on your credit or finances. They're very friendly toward people like that. So if you had a bankruptcy or a foreclosure and you were wanting to buy a property, FHA is actually one of the best ways to go, because the bankruptcy wait is only 2 years and the foreclosure wait is only 3 years. Now, Jason, you said you did a VA loan. Is VA 7 years for their wait on bankruptcy, or is it similar to FHA?
I believe it's the same.
Okay, so it's same as FHA?
I'm pretty sure it was the same. The reason I had to wait 7 years was because even after my bankruptcy, I still wasn't a good little credit risk.
You didn't learn your lesson?
No, I did not. And so that kind of extended mine and made me look worse. I had to wait a little bit longer.
Okay.
I had a truck repoed, blah, blah, blah. But I believe
what are you doing?
I know. But yeah, I believe it's 2 and 3 years as well for VA.
Okay. All right, so check with your lender to make sure on that policy. But my understanding is VA is one of the most forgiving loan programs we have as far as being flexible. If someone has credit challenges, that's usually where we go first. So they say as the slide says 640 plus credit scores, but there are some exceptions where you can do it as low as 580. So just kind of be aware that those are unusual, but you can do it. Bankruptcy is 2-year wait. Foreclosure is 3-year wait. You must own or occupy with FHA. Okay. You can also do 1 to 4 units. So remember, with VA, you could do 1 to 4 units. You could buy a single-family home, a duplex, a triplex, or fourplex. And with FHA, you can buy a single-family home, duplex, triplex, or fourplex. With USDA, my understanding is you cannot. It's only single-family homes. Okay. The FHA loan limit has a max by county. So you need to go look at whatever county you're buying in and look up what the FHA loan limit is to see where you'd be maxed out looking for properties. But typically as nomads, we're not buying at the very high end of the market. We're typically buying below median, but not the very cheapest stuff on the market. We're usually like a little bit off the bottom, the 25th percentile to like the 50th percentile. That's usually the sweet spot for nomad properties. We'll talk about that when we talk about finding properties. But that's really where you're going to be. And so most of the time, the FHA loan limit kind of helps you stay within that limit anyway. There is a special FHA loan program called the 203K. We talk about this when we talk about fixer-upper nomad, where you buy a property that needs fixing up, you move in, you fix it up, and you kind of use the equity in that to jumpstart doing your nomad model. But the FHA 203K loan program allows you to include repair costs in the FHA loan. So you can borrow the money to buy the property, plus you could borrow the money to do repairs. Okay. A lot of non-nomad, non-fixer-up type people sometimes use this when they buy a property that has, an outdated kitchen or outdated bathroom, or they want to redo their flooring. You can actually use that program in order to just do a kitchen remodel when you buy the property, or some flooring remodel when you buy a property. So realize that that loan program can work in more than just the nomad ways if you really are interested. And then just down payment assistance typically used with FHA loans. We talked about that a little bit early. And then 6% down maximum seller concessions on FHA. Any questions on FHA? Oh, we do have a question. Sandy says, is that one FHA loan at a time? Could you refi and get another FHA? And the answer is yes. You can have one FHA loan at a time. There are some exceptions. For example, Jason, do you want to talk about the exception I told you about the other day?
Yeah, that was actually news to me. I did not know about that. But apparently, if you move, or I guess if you have to move more than 100 miles away from your current residence, it's called the reasonable commute rule is what they call it. If you have to move more than 100 miles, or if there is a significant change in your family situation, for example, if you are living in a 1-bedroom and all of a sudden you have twin babies that are born and the 1-bedroom house is no longer sufficient, then you can actually keep the FHA loan in place and get a second one.
And you told me, so I told you about that part of it, which I was aware of, although I've never had anyone use it. Although I was thinking about making a, 100-mile, basically move 100-mile nomad model. But you told me there's actually an additional qualification, which I was not aware of. So what was the qualification you learned about when you were doing your research?
Oh, which one?
It was something about equity.
Oh, yeah. So obviously as the house appreciates and as you get the debt pay down, your loan to value ratio is improving. And once you hit 75% LTV in the house, that means you have 25% equity. it opens up some additional options for keeping the FHA loan and doing a second one.
Oh, so that's not the requirement for that one by itself. That's an additional thing. It opens up additional options.
It was it wasn't. It was shoot.
Rather than guess, if you guys are really
I'd have to look it up.
Talk to your lender. Talk to a lender, and ideally one that likes to go read the rules directly. Don't just have them kind of pull it off the top of their head. Have them go look it up.
Actually, I just pulled up the email I sent you. Yes, it's the 75% requirement, or you have to have reserves in savings to cover a few months worth of expenses on the original mortgage. So
okay.
Yes, it's an overlay on top of the 100-mile rule.
Okay, and just as an aside, so you mentioned the word overlay, and you may be talking directly about the regulations for FHA for everybody. But sometimes lenders will apply additional overlays, and they will say, so FHA normally says 3.5% down. If you're going to get an FHA loan with us, we want 5%. And so going to different lenders have different kind of overlays and how they do stuff. So realize that. So Sandy, let me address your question. So you said, is that one FHA loan at a time? And the rule is yes, most of the time, but there are some exceptions. Another exception I'm aware of is I believe if you inherit a property that has an FHA loan, that's another time when you can have two. And then the other one, you said, could you refi and get another FHA? And the answer is yes. Now, I'm going to jump ahead and answer a question you haven't asked yet, because I think where you may be going with this is you may be thinking to yourself, can I go buy a duplex or a triplex or a fourplex with an FHA loan, live in there for a year or 2 years or 3 years or whatever it is, get some equity built up, refinance out into a conventional loan where you're at 80% loan to value, and then use the FHA loan to go buy another duplex, triplex, or fourplex with only 3.5% down? The challenge you may run into with that is underwriters want to see you move from a multifamily to something a little bit better, like a single family home. And so it really is going to rely on, it's going to depend on whether or not the underwriter who's doing your loan sees a material benefit or a benefit of you getting that loan, and is able to justify and rationalize that, and approve that kind of loan process. So it's hard, especially if you buy a single family home, to go buy a duplex, triplex, or fourplex. And I'm getting ahead of myself because I have a slide on this later. It's going to be hard for you to go from single family to duplex, triplex, or fourplex. It can be done, but I wouldn't count on it. I would not make your plan based around that. So just be aware of that.
Yeah, I actually ran into that when I did my second VA loan for this house. I had to submit a written statement to the underwriters explaining why I was buying a second house in the same city when I already had a duplex with a VA loan, and I had to explain why, beyond just anything related to investing, they wanted a concrete reason for it. And it was actually pretty easy to explain it. The one bedroom unit I was living in was a cramped little 500 square foot place, and I work from home. I needed a bigger home office and more space to live in.
Yeah. So when you're planning on doing this, realize you're going to need to have some reason to move into the next
correct.
Property. And tell them we're not quite at the kind of acceptance and knowledge to just be able to say to the underwriter, I'm doing Nomad.
Right.
They'll be like, what are you talking about? What's Nomad? Okay. So you need to have a real reason for doing that. And you can downsize. For example, I have one kid in college, and actually I got 2 kids in college now. But they're thinking about moving out of the house. For me to downsize, that could be a justifiable thing for me to do. Say, no, my kids aren't here anymore. I don't need a house this big. I can go ahead and downsize. But a lot of times you're going to be moving up or moving sideways into different parts of town or different parts of the neighborhood that have different benefits. So just be aware of that.
Also, James, when I was reading the FHA handbook, the 4000.1 guide, because I'm a nerd and I like to read stuff like that. Right. There was another exception that allows you to get a second FHA loan, and that it has to do with if you have a relative that is going to maintain occupancy on the first house. So if you are, if the tenant you're putting in is a relative, there are some additional rules that will allow you to keep the FHA loan on that property and do a subsequent one as well.
Okay, I was not aware of that one either. That's pretty interesting too.
There's some nuance to it, obviously, but
yeah, obviously. All right, cool. If anyone has any questions, let us know. We can continue moving on, though. So we're moving to conventional financing. Again, conventional financing, that's also Nomad approved. Fannie Mae, Freddie Mac type loans, they're usually fixed interest rate loans, 30-year amortization. And that just means that if you make payments for the 30-year period, you're going to have paid off the loan over that same time period. Why not do 15? Usually we're not doing 15-year loans because it's going to significantly impact cash flow. And I would rather see you be able to have a lower payment that's required. And if you want to pay it down faster, which there's some strategies for doing that, you can choose to do that, but it's not required to do it. Yes, you are going to pay a little bit higher interest rate because 15-year loans tend to have a little bit lower interest rate on that. But I personally think it's worthwhile to do the 30-year loan. 740 plus credit score for best interest rates. For owner occupant, as low as 3 to 5% down. Now, there is a 1% down loan program, at least offered by one lender here in town. It is a conventional loan. It's a special program where the lender is providing you a 2% down payment credit of some sort, and basically it's a 3%, but the lender is kind of contributing 2% to your down payment. So for you, it's a 1% down loan program, but really it's the 3% down one. So we kind of model this. We talk about a 1% down for doing your first property, then you can do 3% down for your second one, and then usually 5% down for all the additional Nomad properties you're doing. That's usually what we model the most aggressive versions of Nomad with. But if you just use 5% for all of them, that's a pretty conservative model for doing that. And then all of those have PMI. So they're going to have that private mortgage insurance. You can get those loans until you have 10 financed 1 to 4 unit properties. So realize there's a limit on the number of conventional loans you can get, and it's limited by the overall number of properties you buy. That includes FHA and portfolio loans and any other type of loans you have on properties. Those count towards your 10. It's not 10 conventional. You can't go get a VA and another VA and an FHA and then get 10. You can get a VA, another VA, an FHA, and then 7 more conventional, okay? It's 20% down if you're doing investments. It's 20% down for loans 1 through 4, and then loans 5 through 10, it's usually 25% down. If you're going to do a duplex, triplex, or a fourplex, add 5% to that down payment. So for the first 4, it's 25% down if you're doing multifamily, 2 to 4 units. If you're on your loans 5 through 10, it's 30% down for those. Okay. Fannie Mae can do cash out refinances up to 4 finance properties. For Freddie, it's up to 6. So just realize if you're trying to do a cash out, you're not going to be able to do these once you start acquiring a bunch of properties. It's going to be much harder for you to do cash out refis once you have a portfolio of properties on there. And then both rate and term refinances, where you're refinancing the rate of the loan, the interest rate, and the term, the duration of the loan. You can do that up to 10 properties, 1 to 4 units. Excuse me. And then the seller concessions, it's 2 to 9% is the maximum. 6% with 20% down. It's usually 2% down for non-owner occupants, so investor properties. So just realize what those loan programs are for conventional loans. Now, most of the time for your additional properties, when you're doing Nomad, we're doing 5% down, paying the PMI, and buying properties that way. That's what a lot of Nomads are doing. All right, portfolio lenders, kind of moving through this pretty quickly. Portfolio lenders are usually banks where they're going to keep the loan in their own portfolio. They're going to keep it at the bank. These are Nomad approved. They tend to be ARMs, adjustable rate mortgages, and they're usually fixed for, around here we've got a bank that we use for a lot of these. They have a 3-year, 5-year, or 7-year term, which means that the interest rate is fixed for either 3 years, 5 years, or 7 years. But it is a true 30-year loan, and the loan is actually amortized over 30 years. It's just that the interest rate starts to become variable after 3, 5, or 7 years. And so you introduce an interest rate risk when you get these portfolio loans. All the other loans we've talked to up until this point, they're all fixed rate financing, and that's typically what we recommend for Nomad. There are a couple of exceptions where doing an adjustable rate mortgage, like one of these portfolio loans, might be acceptable. And it's usually when we're doing lease option exits on the Nomad model, because we're going to be getting out of the property usually before the 7-year point. But it is an additional risk, so just be aware of that. So these are 30-year amortization, 30-year loan. There's interest rate risk. There's no balloon. So unlike commercial properties where you have a balloon on the property, meaning that the whole loan is due after 5 years or 7 years or 10 years or whatever it is, These particular portfolio lenders, at least the ones local, and check with your other one, but there's no balloon on them. It's truly a 30-year loan. Let's see. One of the advantages of these portfolio lenders is sometimes they can be really quick. Other lenders, sometimes they take 30 days, 45 days to close. Some of these portfolio lenders can determine it very quickly. As you get to bigger purchases, they definitely require some loan committees to approve your loan, and your relationship with the bank does matter. It can affect your interest rate. It can affect whether or not they even approve you. So realize if you have deposits on the bank, that could actually help you. If you don't have a lot of deposits on the bank, it could actually hurt you.
What is DSCR?
Loans?
DSCR, what does that stand for?
Debt service coverage ratio. Has to do with how much income the property is producing compared to the debt you have on the property.
Got it.
All right, so lender programs vary. We've talked about this all night. Just because one lender you talk to says it can't be done doesn't necessarily mean that it can't be done. It just means that they can't do it. Their loan program. And different lenders have different kind of overlays and different loan programs and how they work. And some of them look at things very differently. I had a loan very recently where they turned down the loan. We went to another lender. They had absolutely no problem doing it. So just realize that lenders vary quite a bit. So we will be discussing what most lenders will do. So let's talk about some advanced strategies. We talked about this a little bit, but plan your loans. If you're going to get these conventional Fannie Mae, Freddie Mac type loans, and you can only get 10 of them, think that through. You don't want to go and put yourself into a weird situation. I've had some clients, it just worked out that if they had set down and planned some stuff ahead of time, they could have gotten a little bit more advantageous loan position, but they opted to do certain things in certain order, and it kind of came back and turned out wasn't as ideal. So you must be able to qualify for all the loans. Your personal residence, the house you live in, does count as one of the loans, and portfolio loans and the other 1 to 4 unit loans count against 10. We talked about that. And the reason why we like these is that they're 30-year fixed rate financing. After you get to 10, then you're typically looking at portfolio loans or commercial loans or a private lender. And commercial loans for 5+ units don't typically count toward your 10. So if you're going out there and you're buying a 10-unit apartment building, in addition to the Nomad model, that doesn't typically count as one of your 10 loans. So when you're planning your loan spots, think about what your long-term strategy is. Try to do your fixed rate, low interest loans with higher mortgage balances. Now, this is kind of counter to what we teach with Nomad, because Nomad, I tend to teach kind of start with starter homes and kind of focus on those. And then as you kind of develop it, maybe get a little bit bigger with each one so that finally when you're at home 10, it's more where you ultimately want to be. But realize that from a loan standpoint, it may actually make sense, especially with interest rates as low as they are, to start with a bigger loan balance earlier on at the better interest rates. If you're married, one of the things I talk to when I sit down with married couples is, if you trust your spouse, then maybe alternating, you buy one, they buy one, you buy one, they buy one, because then you could get 20 loans between you. If you get loans where you're both buying them together and you're both signing on the loan, that counts as a loan spot on each of you. So go talk to your attorney, because there's some asset protection kind of considerations in this as well. And what happens if they run off or there's a divorce? There's some weird stuff. So definitely get some advice on this, but it's definitely something to consider. There's an advantage to me getting a loan and then Tammy, my wife, getting one loan, and then me getting a loan and then Tammy, because then we could have 20 loans between us. Does that make sense?
Yeah, and I just want to say this came into play as I'm planning on my next 2 purchases when putting into consideration FHA versus conventional, and where I'm going to put the 20% down or not, because of the way the different programs work. It actually requires some planning about how you're going to allocate not just your loan slots, but if you are going to put down 20-25% on a multifamily property, you have to plan when you're going to do that in your Nomad sequence and which loan program you're going to try to use for that.
Yeah, I would agree. You know what the problem with having so much tea while we do these presentations. I am probably going to need to use the restroom at some point. So continuing on, though, for now. So another advanced strategy, changing rate. So you can raise the interest rate and have lender pay some or all of your closing costs. So the idea being, Jason, if you were in your VA loan situation again, and you said, I don't have $8K in order to buy these 2 properties and closing costs. I need to come up with that money from somewhere. One of the ways you can do that is you can go to your lender and you can say, hey, listen, the seller is not willing to contribute toward my closing costs, but is it possible for me to voluntarily take a higher interest rate from you, and instead of it being, $4,000 for closing costs, you give me a credit to cover some of those closing costs? Because if you're willing to voluntarily take a higher rate, they're willing to have it cost less for you to get the loan. And it's kind of the alternative of, if you want to buy down your interest rate, you pay more money. It's the opposite. It's you want to take a higher rate, so they're going to sort of like either charge you less or even give you money to take the higher rate. Does that make sense?
Yeah, that's actually what I did on house number 2. I accepted a 0.25% higher rate in order to bring my closing costs down.
Yep.
Even though that makes for a slightly higher monthly payment,
yep.
It'll still cash flow when I convert this to a rental.
Yeah, so in a weird sort of twisted way, you're financing your closing costs over time by taking a higher interest rate. Yep. So you can also do the opposite. You can lower your interest rate by paying the lender points. So 1 point is typically 1% of the loan amount, for those that don't know what a point is. And then we discuss this, when we teach the ways to improve cash flow. There's a whole class on strategies to get the lowest monthly payment when buying real estate. We're going to be teaching that on February 21st. Or if you are a premium member, you can go ahead and watch the recording of it that I've already done on learntoberichcom/lowest monthly payment with dashes between those words. Plus, there's another class we do, the cash flow explosion class, which is what you were mentioning. I don't know if we were recording when you first came on, but you were talking about the kind of talk I did on improving cash flow. Mm-hmm. This is the latest iteration of that. It's like the 2-hour class where I talk about all the different ways, all the different things that impact cash flow. And we're going to be teaching that class again on August 15th. So people will be able to come on that on Tuesday and listen to that live. Or if you wanted ahead of time, the recording is available for premium members at learntoberichcom, how to maximize rental property cash flow. And that was a recording of a live class I did, I think, last year. So those 2 classes are ways that we kind of improve cash flow using those strategies. Is it better for cash flow to buy down interest rate or to put more down? So, people kind of ask me this question all the time. James, I've got $20,000 extra money sitting around. It's not big enough for a down payment on another 20% down property, but I'd like to get that money working for me. Would it be better for me to take that $20,000 and just put a bigger down payment down? Or, the lender is telling me, hey, listen, I could buy down the interest rate. I could pay them $8,000 or $12,000 or $15,000 or $20,000 and buy down my rate to a different number. And the more I put up, the more my interest rate gets bought down. And which one's better? Which one should I do? Should I put more down or should I actually pay down the points? And the answer is you actually have to do the math, because there are times when it's better to put down more down payment, and there are definitely times when it's better to buy down the interest rate. And you have to make some assumptions about your holding period, how long you plan on holding the property, because the money you put down as down payment, you get back as equity. The money you put down to buy down the interest rate is gone. And unless you keep that loan for a certain period of time, you are not getting the expected return you thought you were getting on that money. And so we have a whole class. We did like a 2-hour class on this where we have you break down what each buy down amount is and what your return on that buy down amount is, so that you can see the return you're getting on paying points in order to reduce your interest rate. And then you could see how much it improves cash flow and all those different things that come into play. It's a pretty interesting class. So I may do one of those classes coming up here. I'm not sure when, because it's not on the schedule. It's one we did recently, though, on a Wednesday night class for the local group. So
I also want to point out that if you're looking at doing Fannie and Freddie loans, that you're going to have multiple loans, especially once you get beyond 4, or if you're doing multifamily properties, most lenders are going to have reserve requirements. So if you have that extra like $20,000 sitting around that you're talking about, you in terms of your long-term loan plan, keep in mind you may need to keep that cash seasoned in the bank to demonstrate reserves for your next loan. So I think that's another consideration as well beyond just the cash flow on your current purchase.
Yeah, that's definitely a good point. So. All right, let's keep moving on because I just looked down and realized we are halfway through and a little bit more than halfway through in time. So Nomad Loan Basics. This is the preferred order, in my opinion, for most people on doing Nomad. So if you can get a VA loan and you can buy multifamily, I think you start there. I think if in an ideal world you use your VA benefits in order to buy a duplex, triplex, or fourplex, and if you can do it again and buy another duplex, triplex, or fourplex, I think you do that. So in an ideal world, if you can get 2 or maybe even 3 VA loans with multifamily, great. In our market, there's very few duplex, triplexes, and fourplexes. And so the chance of you getting one is really, really low. So most of my clients are skipping the duplex, triplex, or fourplex because in my opinion, it's better for you to get a property than it is for you to wait for a duplex, triplex, or fourplex to come on the market. So in the ideal world, VA, multifamily, and if you can do more than one, then once you've used your VA benefit, try to do a multifamily with FHA. And most of the time you can't do 2, so we usually only talk about 1. And then after that, we use conventional financing to do those or refi the FHA to conventional and then try to do another FHA. But in most cases, it's going to be conventional from there on out. So if you do not have the ability to get a VA loan, you skip that one and you do FHA first if you're going to do multifamily. Now, if you can't find a multifamily, sometimes it makes more sense to even skip FHA and buy just single family homes with the conventional, because the conventional ones you can't do owner occupant, low down payment conventional. If you're going to buy a conventional property, and actually Jason, I think you asked me this question because you were almost assuming that you were going to be able to do a duplex, triplex, or fourplex with conventional with 5% down.
Yeah.
And what'd you find out?
I was very mistaken. That plan was not going to work.
Yeah, so with conventional, you can only do the single-family homes with these low down payment models. So we're not doing duplex, triplex, or fourplexes with those. We're only doing single-family homes. Okay. So owner-occupant financing, you have to move in. We talked about this. 12 months is what they make you sign. If they make you sign something that says 18, guess what? We're going to start teaching the 18-month Nomad model. Okay. If they tell us 2 years, we're going to teach 2-year Nomad. If they start telling us 6 months, we're going to start teaching 6-month Nomad. So it's really a function of whatever the lender says is being able to do that. And then the question again is, can you just say you're not going to live there? You're going to live there and just not move in? And the answer is no. It's called loan fraud. Don't do it. Okay.
Unless you're interested in free housing.
Yeah, if you want free housing, that's the way to do it. Yeah, don't do that. In all seriousness, don't commit loan fraud. All right, so modeling income required for Nomad. So when we kind of model Nomad and we talk about all the catch-up Nomad and legacy Nomad, and we kind of go into detail with that, this is one of the charts we make. We basically model how much income you would need for each year that you qualify to buy one of the 10 properties. And I think this property, if I'm not mistaken, is about a $300,000 property, and it assumes you have no other debt. Okay, so if you have a car payment, you have some other debt of some sort, credit card debt, school loan debt, realize you're going to need to earn additional money beyond this to qualify for this property. But this is your estimated gross minimum household income. So if it's you and your spouse, you both need to earn this combined, not each. So in year 1, you need to make $3,820 between the two of you. So you can each make about, what's that, Jason? $1,700, $1,900 a month. Mm-hmm. So $1,900 a month or so with no additional debt. So you could literally buy a $300,000 property if you had no other debt, making essentially minimum wage, $10 an hour or so. Mm-hmm. Okay. And then in year 2, in order to buy your second property, you need to be making $4,500. And finally, in year 10, when we kind of increase each year, but year 10 is the highest one, you need to be making $7,500 combined. So that's about a little less than $4,000 per month each. So a little less than $48,000 per year each in order to qualify for your 10th property to do that. Okay? So that's what it looks like for doing that. And you can model that with the calculator if you're able to log in and do Premium Nomad. It's a Nomad Calculator Classic. You can type in the assumptions about the houses you're buying, and it will create this chart for you and show you how much income you'll need to be earning for that. As an aside, if you have debt, like car debt, I think the rule of thumb, it's a little bit off, but you basically need to have almost twice as much income as your monthly payment for that debt to maintain the same qualification. So if you have a $200 a month car payment, you need to make almost like $400 a month more to kind of keep the same ratios. It's actually a little bit different than that, but that's a really rough rule of thumb. Okay? All right, preparing for financing. So get your financial house in order. Know your credit score and score from all 3 credit agencies. Middle score typically gets used by lenders. Look for anything that's incorrect or inaccurate and fix it. Resolve negatives on your report and consult your lender or credit counselor for ways to raise your score. By the way, credit scoring doesn't work the way most people think it does. You can't go and say, I'm going to pay off my credit card and close my account. My credit score is going to go up. That's not always true. In fact, it's rarely true.
Don't close accounts.
Don't close accounts. Yeah. So talk to your lender and find out what you would need to do in order to make those work. But I basically would meet with somebody and talk to them about what you need to do. Understand your debt to income ratio. To lower this, the lower that is, the better. Get organized and digitize your documents. I think we're going to talk about that in another slide. If you're self-employed, 2 years of returns will be needed showing increasing profits year over year. Don't overstate expenses to minimize taxes. So one of the things I see a lot is, people get really creative about, minimizing how much money they make so that they don't have to pay a lot in income tax on their tax return, and it only ends up hurting them later when they go to get a loan.
Correct.
Because they use those numbers in order to qualify you, and now all of a sudden you're like, but really I make $100,000 a year. I just write off like $90,000 of it, so I only really make 10. I pay tax on 10. Well, guess what? Now you're qualifying based on $10,000 a year income. So don't do that. Budget and save for your down payment and reserves. Kind of obvious stuff. So contacting lenders, finding a lender, call multiple banks and mortgage brokers in the same day if you're going to price quote them. Attend your local Nomad Investor Club meetups. Those are going to be on Thursday in other markets. Here in our local market here in Fort Collins, they're on Wednesday nights. Meet lenders and real estate agents that can refer you to lenders, because most of the agents, they have lenders that they've worked with, that they've closed on loans with, and they know that they're going to be able to perform and get you to the closing table. Be super careful about, picking a random new lender, lender that you just kind of found out of the phone book, or, you found their business card on a table at a restaurant. It's a random chance of you closing, because you don't know. And, they could be superstars, but they could also never have closed a loan before, and, they charge you an upfront fee or whatever they do, and they could never really end up closing loans. So just be super careful about that. I'd get a recommendation from someone who's in the business and who's actually closed loans with people, and or your real estate agent. You may find it more difficult to go to the big bank versus the local banks and brokers, especially if you have more properties and loans. And don't use any of the huge online sites either. Some people have had good experiences with them. I have not ever closed a loan with them. So that may say what I need to say. So calling lenders, ask for rates on the same day. So if you're going to call 2 or 3 lenders, call them up all on the same day and say, hey, listen, I'd like to, I'm thinking about, buying a house, and I want to get rates for a loan to find out which lender I'm going to use. If you know your credit score, what you do is you tell them all, I know I've got a credit score of 760, so believe me now, if I decide to use you, I'll go ahead and have you pull my credit score and verify that what I told you is true, but please give me a quote based on a credit score of 760 or whatever it is, and give all of the lenders on the same day so that there's no variation in rates day to day. Call all the lenders on the same day, give them all the same credit score, and then compare their fees and their rates to each other to find out which one you want to use. But as we talked about in the beginning, it's not always about just rate. Sometimes it's about rate and whether or not you resonate with them and you can talk to them and you feel comfortable with them. Because sometimes, they're going to save you $500, but they're just not nice to deal with, and you're going to dread making phone calls, and you're going to dread getting a loan, and so be careful about that. Don't let multiple lenders pull your credit all at the same time. So don't give each of them your social security number and have them 3 of them pulling credit on the same day. Don't do that. Just tell them what your credit score is. So I've got a couple questions on the next slide about questions to ask a lender. And, Jason, I'm going to put you on the spot, and I'm going to have you, talk about some of those questions while I quickly run to the restroom.
Okay.
But But basically just, talk about in general, when you're talking to a lender, what you look for and what you've seen there. And I'll kind of give you some examples of what I typically ask for, but tell them if yours differs. And I think I've got a couple slides, but we'll start with the basic one here while I run in the restroom. So I'll be right back.
Can do. So yeah, like I mentioned earlier, this was something that I had to shop around outside of my normal banking relationships to find a lender to implement this program with. So first question here, what expertise do you offer for putting the financing together? I like James already said, I don't think you ever want to work with somebody that you're their first loan. That's probably an obvious one. But make sure that they understand and have experience with the type of loan product that you're trying to use. So in my example, I needed somebody that was, able to do the VA loan and had experience with that. And my credit union and my big, national bank didn't. So I had to go elsewhere. Do you know specifically about financing programs for nomads? Work with somebody that is going to understand working with investors, has experience with investors, and understands what you're trying to accomplish in the long run. Current rates for owner-occupant loans. I would say on top of that, ask, like James was talking about earlier, the different buy downs that are available. Or if you're willing to pay a higher interest rate in order to get some of your closing costs paid, ask them about those comparisons as well. How many loans can an investor get in their own name? This will largely depend on their own underwriting criteria. So this is a good question, I think, to see how well they understand their own underwriting criteria.
Agreed. And by the way, that was your opportunity to tell secrets about me while I wasn't around, but you squandered that opportunity. So
it's all good.
Yeah. And by the way, in case you're wondering, Jason probably knows some more secrets than most people. Not that I have any crazy secrets, but he's,
that rager back in '98. No, just kidding.
Yeah, you know better than I do. I'm definitely not a rager guy.
I know. What type of documentation will I need to process the loan? This is, even if you are, you've been employed at the same job for 20 years and you've got perfect credit, things can still pop up. When I was doing my first loan, I thought I had gotten all my credit challenges taken care of, blah, blah, blah. But something popped up that wasn't, actually two things popped up that weren't my responsibility. One of them was a collections action from the city of Seattle for unpaid parking tickets, which was funny because I have never, ever parked at that time. I had never, ever parked a car in the city of Seattle in my entire life. Okay?
I'm thinking about your repoed car. So basically you don't have a car because it was repoed, and now you can't get a loan because of your parking tickets?
Yeah, and it turned out that the person I had sold the car to in question a couple years ago never registered it.
Oh, man,
and so funny. Even though I had filed the notification with the state saying, yes, I transferred the car to somebody else, she never registered it. And so I was still in the city, in the state database, whatever, it was still me. And yeah, so I ended up with these tickets. It took, a week to clear up, but it actually held up the loan for a week. So yeah, understand what type of documentation you need to process the loan. Look for those gotchas. And what kind of down payment will I need to buy a property? There's, like James said, there's some of these, the conventional 99 program, the conventional 97, the FHA 3.5. If there's programs through local, like community housing grants, things like that can help you out. Make sure that your lender is aware of those to help you figure out what kind of down payment you're really going to need to come up with.
Yeah. Well, thanks for going through this. Eddie, by the way, had made a comment here. He said, I heard that with multifamily owner-occupied, 70% of the collected rents from the other units can be used for income. Yeah, that's my understanding as well, that you can actually use income from the other units to help qualify. And in some cases, that really helps. In some cases, it doesn't help that much.
For house number 3 or 4, I will be actually relying on that 75% rule pretty heavily.
Yeah. So let me quickly run through some of these additional questions about fees. So when you're talking to your lender, how do I pay you for your service? Is there a fee on loans that are closed? What's the fee? In my opinion, in most cases, you probably can avoid paying upfront fees. Some lenders charge them, and if there's a compelling reason to do so, sure, go ahead. But most of the time, I don't think it's required or necessary. Is there an upfront fee? Is there a minimum fee percentage and or dollar amount? If so, what is it? Especially if you're in a city where you're at really, really low home values. They may tell you, hey, listen, we don't do loans under 50K or 75K or 100K or whatever it is. So just be aware that, especially in that lower price point, there may be minimums. What happens if I end up not doing a loan with you? This is especially important when you think about paying for the cost of appraisals and any other work that the lender had to do on your behalf. How are those fees handled? Getting on to team questions. Do you have any assistants or staff that work with you that I'll be interacting with? Some lenders that are really kind of big producers, you're not primarily dealing with that lender. You're dealing with their assistants. And so knowing who you're going to be dealing with and making sure you get along with them is important. The lender could be the sales guy that goes out, or gal that goes out and kind of meets with you and talks to you about the loans. And then all of a sudden you're turned over to 3 assistants that just handle everything.
Right.
So just realize, in some cases, I think that's better because it's systematized and, they're doing volume and they kind of work through and they've seen a lot and it can have exposure. So I like that in a lot of ways. Although I do like the individual attention too. So, there's pros and cons to each. So just realize that you could be working with an assistant. What would I be dealing with you directly on and what would I be dealing with them on? So kind of some questions about that. What percentage of your business is from new clients? What percentage is from repeat business? If, a lender only has new business and they don't have any repeat business, that's a little red flag for me, that no one's coming back and doing another loan with them. Could be a sign that their quality is kind of lacking there. What percentage is referred from existing clients? I personally like to see a lot of people that get referred, because that's a sign that they're doing a good job and they trust them with other people. Do you have a few? And that means 3 existing clients that you work with in the last 6 months. That does not mean friends from high school. You want recent people that did loans with them recently. Then call us references. You probably want to get investor Nomad references if possible. You can kind of call them up and just kind of get a feel for what were their experience with that particular lender. And when I kind of go through these things, some people say, James, you're a little over the top. You're a little crazy. So Jason, am I a little over the top crazy? Most people asking these questions. What do you think?
I think that this level of due diligence for such a massive purchase is totally in line. There's nothing out of line here.
Yeah, and I don't think most people do it, right? I think that very few people are going to go to that extreme, but. So if I refer you to 3 lenders that I've worked with and I've done a ton of transactions with in the past, are you going to have to go and ask them for 3 references? No, I probably could tell you about 3 experiences I've had with them. And you might trust me more because it's just I'm dealing with multiple people and I know that they're taking care of you. But if you're going cold, definitely asking for some of this stuff.
Well, this is, I think, by the way, this is an aside, but this can be something that's really huge about having the local Nomad investor clubs.
I agree.
Because, it's going to take, maybe a year or so to get there in some cities, but you're going to have this network of people that have done transactions that you can ask these kind of questions and get referrals to the better lenders and the better real estate agents, et cetera.
I totally agree. And I think there's another component to that, and that is, real estate agents and lenders that have kind of watched these videos on Tuesday night and gone to the Thursday meeting to be supportive and to help their clients there, and also to get business. They're there to get business, but if they're kind of participating and learning, they might understand what we're trying to do and understand some of the nuance and some of the pros and cons as to why we're recommending things and not recommending other things. Because you may go to a lender and they're like, you should do this because that's what all of my clients do, but we teach something contrary and we do it for a reason. And so them coming, I can't think of an example, but them coming to the classes and hearing why we do certain things may help them rethink stuff that's going on with them and why they recommend stuff.
Well, I can actually give you an example.
Okay.
If you're dealing with a VA or FHA and you have to address these MPRs, the minimum property requirements, the health and safety requirements for the property, the closings can take 3 or 4 months. Okay.
How long did yours take again? Because we don't see a lot of that in our market, but I know yours took a long time.
My first one took 4 months. The second, actually, they were both 4 months.
That's crazy.
But it has to do with the reinspection, because the appraiser is essentially acting as a home inspector at this point. And so the thing that came up, and I don't think that a lot of lenders would have thought about this, has to do with the fee for your rate lock. And if you miss the time period on that, you might have to pay a fee to extend your rate lock.
Yeah.
Right. And so my lender was smart enough to know that this was going to be an issue because we only have 2 VA approved appraisers in the entire 2-county area. And so it causes these scheduling delays. And so she knew not to lock our rate until we were absolutely certain we were going to be able to close, because we had to extend closing twice.
Wow, that's really crazy.
But she knew that.
And this is yet another reason to kind of connect with your local Nomad group, because if I heard that story, I wouldn't tell that story in our local market. And so somebody in your market might think that's extreme, but that might be normal in your market. And you need to have other people doing deals where you can connect and network and meet with them on Thursday and group up. So, and those are free. You're welcome to go to those for complete free. So let me get back to this because we've got some time issues going on here. So here's an interesting one where I talk about, who your worst client is. And I want to find out what their complaint is. So we asked the lender, I realize that people don't always agree. If I stumbled upon your most troublesome client, what would be their biggest complaint about your service? And this is a huge warning for me. If they say, oh, I've never had a problem, all my clients love me, they've never done anything, in my opinion, that's a big red flag. Because even in my business, and I think I do a pretty good job. I mean, you talk to the clients that like me, they're gonna tell you I'm amazing, right? But if you talk to some of the clients that have not had good experiences with me, and there are definitely clients where I was not what they were looking for. One of the things they probably would complain about me is I am not going into the MLS and pulling out deals for them and calling them and saying, you should go buy this property. I'm just not proactive at that level. Okay, so if they're looking for fix and flips, or they're looking for great cash flow and properties, and they want me to go ahead and call them personally when a deal comes up, I'm not going and analyzing properties all day long for particular rentals. I mean, I provide tools for clients to do that themselves, and I'm happy to serve clients, but I'm in more receiving mode than I am in aggressively calling mode. And so people would complain about that. If they expected me to be finding deals for them, that's a legit complaint. Another one came up today, and I know he's on the webinar here, but it's an ongoing thing for me where people say, hey, James, would you run comps for me on this property and tell me what the value is to decide if I want to make an offer or whatever it is? And I just don't do that. I mean, I ran the largest wholesaling network in the U.S. and we're in 280 markets, and we're doing analysis on a bunch of properties and stuff like that. But I'm not going out there and doing this analysis on properties and determining value, because you need to physically go to these properties and see them, and then look at the comps and see what's different about the comps, and why did this one sell for 280 when this other one sold for 260. And trying to do this remotely, it's really hard to do, and it's not very accurate. And if I told you, yeah, you should totally spend 290 on this property, and really it's 270, I don't want to cost you 20 grand. And so by playing loose and easy and stuff like that, people could become upset by that, by me not being willing to go and run comps and tell them exact values and things of that nature. But I personally think it's a better service when I'm upfront with people and I tell them, this value thing, it's all over the place, and you really do need to spend a little bit more time than me just running exact comps, unless all the properties are identical, and then it's super easy. But there's usually differences, and so that's why we don't do that. But,
well, I think another big thing with you in particular is you're also not the person to work with if somebody's new to the area and they want someone to drive them around for 4 hours looking at 15 different houses so they can get a feel for what Fort Collins market looks like, right? That's not what you do.
Right. Yeah, and the jokes about me not going north of Horsetooth, right? I mean,
correct. Right.
It's a big deal for me to go to Old Town. So yeah. So but that's my personality, right? It's there's certain things I do really, really well. If you want someone who's a real estate agent who's going to sit down and educate you and give you all the tools you need and explain to you a lot of things and kind of give you that level of service and be there for you long term, that's probably me. Yeah. But some of these other things, I'm just not a good fit. And so if you went and talked to some of the clients that were not happy, that's what they're going to tell you. And I think that's fair. And I think with a lender, knowing where their kind of service levels are and what they're willing to do and what they're not willing to do helps you decide as to whether or not it's going to be a good fit for you. So that's the idea behind that question. Have you worked with any real estate investors, nomads, that have invested like I'm doing? Can I call them about your service? Just kind of finding out what they're doing there. Let's see. So applying for a loan. So you'll likely be asked for the following and more, including your firstborn child when you kind of apply for a loan. The loan application process, personal financial statement, those are pretty standard. Color copy of your ID, recent W-2 and pay stubs, and any other proof or sources of income. Last 2 years of tax returns, pretty easy stuff. Some of the things that people may not realize is all your bank, investment, IRA account statements, for 1 to 3 months. So the last 3 months or so of statements, not unusual to get asked for those. Documentation of where the down payment is coming from. You can't just have, $20,000 worth of marijuana sales money show up in your bank account and think that that's going to be okay in order to get a loan. They're going to want to know where it came from. Mm-hmm. So be aware of that. You can't just deposit money from dad or mom without documenting where it came from. You can't borrow the money from your girlfriend because they don't like you borrowing money for down payments. So just be aware that you're going to have to document it. Ask questions about this if this is a concern for you. Documentation of any large deposits in your account. Talked about that a little bit. Leases, insurance, HOA, mortgage statements for all of the properties you own. The HUD-1 or settlement statements from recent purchases. So if you know that they're going to ask you for all this stuff, especially if you're going to do loans over 10 years and you know it's going to be required, maybe it's a good idea to make one Dropbox account and put all this stuff in there and just keep it up to date. That way, when you have to send it over to a lender, it's like all done and you're not spending 4 hours one evening when you're trying to rush to get an offer in or get a property under contract that you're doing all this stuff. Maybe it'll take some time to plan and just kind of keep it up to date all in one folder. Might make a good idea. What do you think, Jason?
Absolutely.
Yeah. So tips for Nomad. If you know you'll be doing this again, create a process now so it's easy to repeat. We just talked about that. Highly suggest creating a folder with all of your application documents, updating this information each quarter. Dropbox works great. You can simply send the lender the link and get them all the stuff they need. Okay. All right. That's the first 10% of the presentation. No, I'm just joking. We've got about, 15 more slides. So it's going to be close. First meeting with your real estate agent. So we just talked about financing. That's what that little blue box is. Now we're going to talk about the financing part when you're writing your offer. So by the time we go to write an offer, you're going to want to have at least, at a minimum, from your lender, a pre-approval letter. You're going to want them to have, kind of run your score, run your numbers, and tell you you can buy a property up to $400,000 or whatever it is. Okay. Some lenders, and I think this is a big bonus. Some lenders are going to completely put you through underwriting, make sure you're totally qualified, and they're just waiting for a property address to make sure that you're done. And I think that's a better, more thorough process if you can get it. So if you're able to get not just preliminary numbers done, but fully through underwriting, just waiting for the address of the property, that's better. In theory, and I think in practice too, especially if I'm calling them and I'm talking to the seller's agent saying, my buyer's completely through underwriting, they're rock solid, they can get the loan, they can go up, higher than that. In some cases, most of the time, I'm not saying that, but they can qualify for much. This is going to be an easy purchase for them. Pick their offer compared to another offer, especially when you're in multiple offer situations. So ideally, be underwriting, get a pre-approval letter that we can include with an offer. And by the way, don't wait till the last minute. So imagine you went to a lender. Imagine you haven't gone to a lender yet, and we start looking at properties. And we go out on Thursday night and we start looking at stuff, and just by chance, the first night you're out, and you'd be surprised how frequently this happens, but the first night out, you're like, I love this property. This is my Nomad property. It's amazing. Numbers look good. I love the location. I love it. We got to make an offer. We got to make an offer right now. And 6 o'clock at night, your lender's not in, and you need to get the offer out right away. Well, guess what? We're waiting until the next day. Whereas if you had gone ahead and talked to the lender first and gotten a pre-approval letter before we get in the car and started looking at stuff, then you will have something in hand that we could make an offer that night and get an updated one the next day with a little bit better information. So
I was actually guilty of this. First house I looked at for house number 2, fell in love with it. It was the perfect property, but I hadn't gone through the pre-approval yet. And 2 days later, by the time we got all that situated, the seller had already accepted another offer. So.
Yeah, there's a lesson learned.
Yep.
And in our marketplace, Northern Colorado, it's really hot. I mean, our market, we're seeing multiple offers on properties right away. So it's even more important there. But in normal markets, I still think it's important because the properties that go quickly are the good ones.
Right.
They're the ones that aren't sitting on the market for 6 months. So just realize you should be ready to go. All right, working with real estate agent overview. So we talked about the first meeting. Now we're going to talk about pre-showings. Before we go on showings for the property, we qualify for the lender. We talked about this. We call one or more, get pre-qualified. The ultimate goal is to get the pre-approval letter. You'll want to make a formal application, understand what they'll need, and provide it to them as soon as possible. Get rates from them so you'll know what to plug in when you analyze deals and what your monthly payment will be if you're buying owner-occupant. And ideally, you want to know what your comfortable payment is. The payment would be on the properties that you'd like to be buying at, because a lot of times you come in and you're like, okay, I'd like to be around 300,000 or 200,000 or 500,000 or 800,000, but I'm willing to go higher. What do I qualify for as a maximum? Because if you're out there looking and you tell them I only want to qualify to 300, and you happen to see something that's 330 or 340 or 350, and you haven't found out that you're really qualified up to 400, you don't know. So find out what your max is and what the payment would be at your max, and find out what your kind of sweet spot is where you'd like to be, and find out what your payment would be there. Okay? All right, so pre-approval letter, we talked about that. Get this before you look at properties. If you're going to be working with an agent, have the lender send the pre-approval letter to your agent as well so that they have a copy. When we make an offer, like if you were making an offer with me, usually I'd ask the lender to adjust it with the exact offer price. So if you're qualified up to $500,000, but you're only buying a $300,000 property, we will ask the lender to make an adjustment to show that you qualify for the $300,000 loan, because we don't want the seller to come back and say, but I can go ahead and ask for more because they're qualified for more. Mm-hmm. So we want to show sort of like you're qualified for that, but you can't go any more than that. Sometimes with lenders I've worked with a lot, they will give me permission to modify it. They will say, he's qualified up to 500K. You're welcome to adjust the loan amount down to whatever you need. Just send me a copy so that I know it's out. And if someone calls me about it, I know. And I say, okay, no problem. I can do that for you. And then we will include that pre-approval letter with the offer via DocuSign, which is our electronic offer-making process. So we talked about this, writing the offer pre-approval letter, exact price you're qualified for. Just talked about that one. Get included with your offer. And I usually put that at the very beginning of the offer itself.
Quick question on relation to this. In your market, are you having to use escalation clauses a lot that might conflict with that cap on the lender letter? Mm-hmm. On the pre-approval letter? Yeah, we are seeing some escalation clauses.
We are trying not to use them. The law firm that we hire to do some stuff for our firm, like some paperwork, stuff like that, they are very anti-escalation clauses because there's some wacky things. And I wrote a couple articles about escalation clauses and why they're kind of weird and why we don't recommend using them. Some sellers specifically say do not send escalation clauses in their broker special, like secret comments for brokers. So realize, sometimes if we are doing that, then we need to make adjustments in the loan stuff, and I've got enough down payment to make up the difference, and all that other stuff if we're going to do it. But most of the time, I'd say more times than not, we're just not doing escalation clauses.
Okay, interesting. They're pretty common out here.
Yeah, and I think they would be common here, but there's some problems with them. There's some real issues. If you want to read that article, I'm happy to send it to you.
Yeah, I'd like to read that.
So let's see. After initial underwriting, you're going to receive a list of conditions for loan approval. I'm going to see examples on the next slide. The list will be longer if you don't submit everything up front. So go ahead and submit all the stuff we talked about already, and they may ask you for some additional things, which I'll show you. And then respond as quickly as possible. Don't say, I've got 5 days to get this to them, because it's going to delay your stuff. You want to get it to them and have it happen as quickly as possible. So go ahead and do that. One of my clients believes that this has caused lenders to go the extra mile for them. And I believe it's true. I believe that sometimes lenders will work for people that are on top of their stuff. And other times they'll be like, they made me wait 3 weeks for those documents. You can wait for my stuff. And it's sad that that's the case, but I could totally see certain lender personalities where that is like, they made me wait. I'm just going to, obviously it's not a priority for them. I'm not rushing my stuff now because they waited so long. So here are some sample loan conditions. I'm not going to read through them, but they're pretty crazy. They want copies of old leases and, old mortgage statements with things redacted and things kind of showing up on there. And, it didn't have your account number. I need something that shows your account number, and, a tax statement. It's all sorts of wacky stuff. These are actual examples from a client. So continue on for post-closing. So if you're going to do your refinancing after you've bought a property, just realize that you can do a rate, which is the interest rate, and a term, the duration of the loan, refinance. They call them rate term refinances. Take the current loan and change the rate and the term. LTV stands for loan to value, is allowed to be typically 80% for one unit and 75% for the multifamily, 2 to 4 units. A new appraisal is going to be likely. Some will allow refinance, the closing cost, the appraisal, and the rate buy down to be rolled in. So that's kind of helpful. And then typically used for lowering the interest rate. So we're in a really low interest rate environment, but it's possible interest rates could go lower and we would refi out. But a lot of times we would see this if we had a higher interest rate, and rates have since come down. If you're going to do a cash out refinance, the new loan includes the old loan plus the cash that you were paid at closing. So you're pulling cash out of the deal. And then the loan to value on those is typically 75% for single family homes and then 70% for 2 to 4 units. So you can't go nearly as high if you're pulling cash out. If you're just refinancing the rate and the term of the loan, you can do a little higher loan to value. Does that make sense, Jason?
Absolutely.
Okay. And then new appraisal is required, typically used for buy, fix up, and hold if you're doing the cash out refinance. The goal is to get all the money you put into the property back to use on the next one. In fact, I'm teaching a class on this next Wednesday for the local people. I'm not teaching it for Tuesday Night Nomad because it's not the Nomad strategy. Some lenders require seasoning of the property up to 12 months. So that might be a requirement for you. And then refinancing as owner occupant may, and I'm actually tempted to say usually, but they may require you to live there for another year. So if you go and you say, hey, listen, I want to do a refinance on this property, and you're doing it as an owner occupant and getting owner occupant rates, they may say you're required to stay in that property now for another year. And so, if there's a lender on that has loan programs that don't do that, let me know. But my understanding is that that's pretty typical. Any questions on refinancing? All right, Jason, this is your time to shine. So what is this that we're looking at?
So this is a grid from my lender that she prepares multiple iterations thereof based on any scenario that I propose to her. She obviously has a software program that puts this together. But I give her, I want to do this, or I'm looking at this, run me the numbers, and what am I looking at for payment and all the fees. So yeah, that's what you're looking at. This is from before I had actually found house number 2. So I actually only ended up spending $180,000 on the house instead of $200. But this is what originally I was looking at.
Okay, and so when you're looking at this is basically one option. The first column is a VA single-family residence loan. Mm-hmm. The next option was a conventional single-family residence loan with 5% down. Mm-hmm. The VA one was nothing down. The VA duplex was nothing down. And then the conventional duplex, you had to put 20% down, which shows you on here.
Right.
Okay. And so, when you're trying to compare these, because I've not really looked at your sheet, and by the way, different lenders have different versions of this. Not all lenders can do it, but some lenders basically subscribe to software where you can put in different loan options, and they will print out sort of like summary sheets where you can compare side by side what the differences in all these different things are. And so if this is important to you, make sure when you talk to a lender that you can get this from that lender. But when you were looking at this, Jason, what were the things you were kind of looking at and considering, and what were your takeaways from it?
Well, obviously you can tell I was still not sure whether I wanted to try getting another duplex one way or another, or do an SFR. So I really wanted to look at the financial scenarios, comparing those two options in particular, and what I'd be looking at in terms of, if I did do another multifamily, with the down payment, I wanted to know, okay, how can I model my cash flow on this? Yeah. Using some of your tools, actually. Mm-hmm. So yeah, I was looking at a lot of different factors, not just, okay, am I going to use my VA again or not? Or am I going to do duplex or not? I even had her at one point model 15-year loans. Because I'm actually I'm doing mortgage payoff acceleration, which I know is not part of your normal model, but I have my own reasons for why I want to do that.
So just to be clear on that, let's talk about that for a second. So
okay.
You said, it's not part of my normal model for nomads to actually aggressively pay down their mortgages. And you're right that we don't teach that. But I think for certain people, especially someone who's trying to do catch-up nomad and they've got surplus cash flow coming in on the property or surplus income coming in elsewhere, there are some reasons why you might want to aggressively pay down properties in order to speed up the process. If you realize, though, that whenever you make those advanced mortgage payments, the return you're getting on your money is the interest rate.
Correct.
So, if you have, an extra $40,000 or $50,000 sitting around that you wanted to kind of pay off your mortgage with, realize the return you're getting on that money is 4.5% or 5% or whatever that is.
Right. Absolutely.
And so if you think that's a good return for you, great. And then you're welcome to do that. And it's a pretty conservative approach. Me personally, I'd probably hoard that money. My personal philosophy is I'd rather have a huge amount of cash in the bank and higher debt on my properties, knowing that I could weather storms better than to have lots of equity in properties that's not liquid, that I can't get out should the market turn on me or something unexpected happen like a job loss. I'd rather see that $50K sitting somewhere and it's worth that 4% or whatever that I'm not getting on that return to have that money sitting aside. That's my personal philosophy, but I understand why you'd want to pay stuff off.
Right. I understand the cash hoarding, especially given my financial history, like I talked about earlier. But also because of that financial history, and also because of the fact that I don't plan on staying in the United States. I fully intend to go back to being a nomad and vagabonding around the planet, because that's important to me.
Yeah. The tricky part, here's the tricky part with you paying down the loan, and I'm not sure we should get into this, but I'll kind of diverge for a second. So if you pay down your loan, it's not like you're lowering your monthly payment. So there's no real short-term benefit from you. There's a great long-term benefit. You basically pay that thing off faster, but you're not getting any extra cash flow by paying $50,000 more on your loan because the payment is fixed.
Right.
So that's the one downside I have about it. I'd rather see you sit on a chunk of cash knowing that if you have a vacancy or a CapEx expense, CapEx expense is redundant, but a capital expense, then you can actually use that cash in order to do it, and you'll have enough money to buy your next Nomad to do it. And I would rather see you put more down on your next Nomad property than to pay down an existing loan you have.
Yeah, I'm doing a strategy where I'm balancing my cash holdings and balancing out my desire to pay off faster in order to retire sooner from the cash flow from the free and clear properties.
Yeah.
I'm balancing that out much less aggressively than I probably talked to you about like a year ago. Okay. So
looking back at this sheet though, I want to point out something, and that is I'm looking at this top half, basically where it says total payments.
Yep.
One of the things I wanted to point out there is like your VA single family homes SFR on the left hand side is $1,150 for monthly payment, but the conventional 5% down is $1,331.
Yeah.
And that's primarily, in my opinion, mostly your mortgage insurance, and that's that ESTMI payment. Excuse me, $171, kind of right there. And that's really the difference between those things, because the taxes are estimated to be the same, the insurance is estimated to be the same, the HOA is estimated to be the same, the payment is within $10 of each other.
Right.
But really the big difference is that MI.
Yeah. Another thing I want to point out is look at the financed MI. So the upfront mortgage insurance that's financed into the loan.
Where is that?
The 6270 in the purple up above it on the conventional SFR.
Oh, yeah.
Okay. So there's upfront mortgage insurance and the monthly mortgage insurance.
Yeah.
Whereas on the VA side, there's the VA funding fee, which is essentially a mortgage insurance premium, more or less.
Why is there a financed MI on your 20% down conventional duplex? Oh, because you only put 20% instead of 25.
Correct.
Oh, okay. So here's the interesting point. So I get asked this question quite a bit by people. Say, hey, James, I'm only putting $10,000 down. If I have extra money, shouldn't I put 20% down, get rid of the PMI, get rid of that $171 a month, and have a little bit better return? And basically, I'm just pissing that money away because it's insurance, right? I'm not going to default, so it's insurance I'm paying that I'm never going to use. And my argument to them is, yeah, you could totally do that. And, in some ways it makes sense to have a big cushion of equity in your property, 20% down, and, not have an MI and increasing your cash flow by the 171, which is the MI plus whatever the difference is of putting 5% to 20% down. That 15% difference, you'll improve your cash flow as well. But here's the difference. So instead of coming up with 20% down on a $200,000 property, you now have $30,000.
Right.
And that $30,000 with your MI payment of 171, you basically have 175 months before you would use up the same $30,000 by paying that 171.
Exactly.
Here's another way of me saying it. Instead of paying $30,000 up front, you're instead going to pay $171 a month in PI, in the PMI, the private mortgage insurance.
Right.
So you're financing the $30,000 as for over 175 months over that period of time. And so 175 months is almost 15 years. So 15 years later, would you have rather put down the bigger chunk, or would you have rather kept that $30,000, used it for another investment, or kept it as a cash buffer, or used it to pay the 171 or whatever you were going to do, knowing that rents are probably going up over 15 years. You probably paid down debt. You may not even own the property at that point. And so it's just something for you to think about and do some math on. But it's not as clear cut as I think a lot of people make it out to be.
That is exactly the reason why I went with I ended up doing VA, SFR, and I had a couple different scenarios of, I could pay some points, buy down the rate. When I was getting ready to lock my rate is right when the election hit, and there was that that really short term, like 2 or 3 week run up in rates is right when I was locking.
Okay.
And so I had to make a decision quick. And so ultimately I did exactly what you just did on the math. I said, okay, my payment at the 4 and 1/8 versus at 3 7/8. Okay, that 0.25% difference. What is that going to equate to in terms of my monthly payment? So I took the difference in the monthly payment and the difference in the closing costs, and it was going to take me 10 years to make up that difference. So I said, forget it. I'll just save the $2,000 and keep it in my pocket, especially knowing that I had to put new flooring into house number 1.
Yeah.
Right. And that was $4,000 for the new flooring. So I was like, I'll save the money now on closing costs for house number 2, so I can put the flooring that I want instead of, cheap carpet or something into the house. And I'm not going to worry about the 10-year difference, especially given the fact that I'm on the way that I'm making my accelerated payments, I'm making a 15-year payment anyway. So it just made sense to take the higher interest rate, which a lot of people think, why would you want the higher payment? But
no, that actually makes sense to me. So that's pretty interesting. Yeah. So this was basically the last slide. Anyone have any final questions before we kind of end the call? And what did you guys, I'm kind of getting some feedback because last week I did the presentation solo on the webinar. This week I wanted to bring Jason on because he's a sharp guy and he's on the Nomad path as well. Maybe just 1 or 2 steps ahead of you guys with, on his second one, he's going to be doing his third here next year. And I wanted to see how you liked having more of an interactive conversation style presentation than a James just, kind of goes to Freaky Town for 2 hours and watches the presentation. So what did you guys prefer? How did you guys like that format versus the other format? You could let me know in chat. That would be amazing. So while they're doing that, Jason, I just want to let you know, I really do appreciate you coming on, and you are a really sharp guy, and I definitely value your opinion. And I think a lot of what you shared with people is both motivational and also educational. I mean, I think some of your thought process and your kind of experience with going through this recently is definitely helping a lot of people. And, I definitely appreciate you sharing. Teddy says Jason was a good addition to the presentation. So yeah, Timothy says, dig it, think both ways work well. So appreciate that as well. So I really do appreciate having you on, and hopefully you'll join us for some other presentations in the future if we decide to do this again. So yeah,
like I said, anything between now and the end of tax season, I'm more than happy to be on after tax season's ending. I'll be hitting the road for a while. So.
Okay. Fair enough. That sounds good.
Well, I gotta go make money so I can buy the next house.
That is true. That is true. So I definitely appreciate you coming on and doing that. So any last minute questions? Otherwise, I'm going to let Jason go, and I'm going to go grab myself a very late dinner because I got kind of sidetracked with some work while Tammy's out of town. So anything from anybody? Otherwise, we're going to – someone says my first webinar is really great format and information. So, yeah, thanks for that. I appreciate it. Not sure who that is. It says anonymous. So yeah, appreciate you guys all coming on. Thank you again, and I will be processing the recording and getting the recording up onto the learntobirich.com/meetup page on the website. So it's learntobirich.com/meetup, and if you go there, I'll have the recording up. Ideally, knock on wood, either really late tonight or early tomorrow, provided it recorded, and then I'll keep it up for Wednesday until the live meetups on Thursday evening. And then it comes down because then we start looking at next week's class. Next week's class is, I think, buyer process overview or something like that. So anyway, thanks for everybody for coming, and I appreciate it. Thanks again, Jason, and I will talk to you all soon. I'm going to end the webinar now. Bye-bye for now.